Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin. Craig is a certified financial planner and he has his own company, the Family Wealth Consulting Group. Maybe I shouldn't say, he has a family business. So we'll be seeing in other episodes other members of Craig's family, his wife Peggy, his daughter Hillary, and now he has another daughter who's working in the business, and it's
Yes.
Alyssa, right?
Very fortunate to have both my daughters and my wife in the business with me.
Yeah.
I have no vote, but it's fun to have the family in the business.
Yeah, well, sometimes that can work and sometimes it doesn't, 'cause sometimes they sort of take over. But anyway, I think you've got a pretty good group together with your
Thank
family.
You, Mike. I think so too.
Anyway, the Family Wealth Consulting Group is a fee-only financial planning company. So I think that's an important thing to bring up from the outset. And what that means for people as investors is that they have fiduciary duties. In other words, you're supposed to put your client first rather than some other company first. He's been providing asset management services for about 31 years. Craig has written a book. It's called Craig Martin on Asset Class Investing, and I'll bet if you sent him an email or gave a call, they would be glad to send you a copy. I've known Craig for a number of years, and so has some good information, wonderful insights related to investing. And today, Craig and I are actually going to be talking about investing basics. So forgive us if it seems a little fundamental, but I'm trying to provide information for people at all different levels here. So this may be a time to bring in the kids or bring in the grandkids to get some real basic information related to investments. And if they don't catch this one, we're going to be posting it on the internet at financialinsiderweekly.com. So this might be one that, again, you might want to share with your family. Craig, thanks so much again
Mike,
for joining me today.
That was a great introduction. You're doing a wonderful thing for the community, the financial community here, Mike, by doing these recordings. You have recorded some of our industry's very, very best, and put into legacy their thinking and recommendations. Mm-hmm. So I'm honored to be a part of that list.
Well, thank you very much again. Okay, Craig, well, let's get started. And so from the very top, why do people even need to understand investing?
Oh, investing is a big word. Some people think it's as easy as picking the right stock or the right real estate address or the right bank for their savings account. Mm-hmm. The truth is that financial planning would be a better word for the term, mm-hmm. because, excuse me, you shouldn't be making investment decisions without understanding what your goals are, where you want to go with it, what you have to achieve to mm-hmm. meet your needs, and what you'd like to achieve. Mm-hmm. There may be two different numbers there. Mm-hmm. Financial planning incorporates a coordination of both estate tax planning and income tax planning with investments in cash flow. Mm-hmm. So making an investment choice takes into consideration how you want to title the asset based upon your estate planning, your legacy goals, what the tax benefits are from that investment, if any, and what the investment is and how it fits into the marketplace, and what your cash flow is out of that investment program. Mm-hmm. Pre and post tax cash flow, by the way.
Okay.
So investment is a broad category and is more than just picking the right place to invest your money.
Mm-hmm. Okay. We'll get into, again, a little more details related to some of this later. But when you brought in the tax issue, of course, that's my bailiwick to some degree as a CPA and a tax advisor. And this is the most difficult time maybe I can remember in my entire career, tax planning wise, because we just don't know what is going to happen.
Don't know.
Yeah. So
Mike, your business is is under every day Congress meets, we're at risk to them doing something hopefully right, but mostly it turns out not very questionable as to how right it is.
Yeah, there's that old phrase, maybe it was Ben Franklin that said, I can't remember, but no one's life, liberty, or property is safe while Congress is in session.
Yeah.
Okay. So, well, let's get started then talking about some of these investment basics. What are stocks?
Whoa, that is basic. Well, let's start out with capitalism, business. Somebody starts a business and wants some capital to expand her business so that she can take her ideas and product out into the marketplace and make the maximum profit. So stock is a way for the investment world, for investors, to give this business owner their money in an effort for the business owner to execute their business plan and make a profit with it, and then share that profit with us, either through dividends and or increasing price of the stock on the market. So that investment that I make into her business can be a private investment, so that friends, family, and founders normally put some money into a startup business for someone that's intimate to them, and the next day they can't get the money back out because there's no place to sell it. In contrast to us buying stock in Intel, or worse yet, Facebook, where for those of you who are watching, Facebook just had their IPO last week, so we're kind of inundated with that information. So the next day we can sell that stock because there's somebody else that wants to buy it. And the price of that stock's dependent upon what the investing public thinks the current dividends paid into the future will be, as well as how they think the business plan can be executed successfully and increase the underlying value of that company. Our hope is that we can buy a stock at whatever price, $10, and have it pay 2 or 3% dividends, and down the road be able to sell the stock for $20.
Okay. And so one thing I want to make clear to people is that stock represents shares of ownership in a company. So when you say a business owner is going to get, well, it means that in a sense they're soliciting partners or co-owners, if you will.
Yeah, good.
But we have a legal form of ownership called a corporation. And so partnerships don't issue shares the same way that corporations do. You can be a partner, but in corporations, typically it is shares of ownership, and that is represented by the stock. It gives you a vote related to certain matters, but a distinguishing characteristic from American capitalism is that the management of the company is separate from the ownership of the company. And there's a liability aspect too, that the shareholders are only exposed up to the amount of their investment in the company. If the company does something wrong and so is subject to some sort of a lawsuit, the shareholders are legally protected unless, again, they're actually involved in that activity. So,
Mike, that was great.
Yeah.
The difference between a CPA answering the question and a financial planner. That was good.
Okay. So,
very complex subject.
Yeah,
We
it
go on
is.
and on and on about just a simple thing like stocks.
right,
So go ahead.
right. But again, people need to understand what they're getting into when,
Sure.
when they're buying stock.
Yeah.
Okay. Now there are different types of stock. There's common stock and preferred stock, and maybe you can tell us a little bit about the difference.
Yeah, common stock is normally what the entrepreneur starts out with in the business. It's what's originally issued for that corporation. It represents the original equity that was put into the business. And preferred stock is normally issued for subsequent investors, in particularly a private round. That preferred stock has preferences, rights, priorities. It is paid first upon dissolution of the business or a bankruptcy,
Huh.
prior to the common stock, that is. It normally has a preferred dividend structure. It may pay 1, 2, 3% dividends when the common stock pays none or less.
Mhm.
The preferred stock could have a right on sale of the company on the back end for a private company, not a publicly traded company. The preferred stock, what else am I missing, Mike? I'm thinking of a private investment because that's
Yeah.
what we've been involved with here recently.
Yeah. Well, it's just that different investors are looking for different things from their investment. And so if people are looking for cash flow from their stock, a little bit like a savings account, then they might like to have a preferred stock as the investment alternative because they do state a dividend that will be paid. Sometimes those are cumulative and sometimes they aren't. What that means is if it's not paid, it may be, if it's not cumulative, then, well, we just skipped a dividend, too bad you don't get it. If it is cumulative, then if we can pay it at a later date, we will. And again, these will have a preference over other dividends for common stock. There is another, like I said, you can have all kinds of different rights, but an important one is the right of conversion. So this applies particularly for preferred stock, but it also can apply to some bonds, for example, that they may have a feature that it says, okay, I've decided this growth of this company looks more attractive to me, and or maybe the conversion, let's say I can have a thing that I can convert 1-for-1 a preferred share for common. Now it may be some other ratio. I'm just throwing it out as an example. Well, now the preferred that I bought, it was $100 that I invested, and with the dividend that it's paying, maybe it's still trading at around 100, but the common stock may have gone to 200. Well, gee whiz, that looks a lot better to me. I think I'll go ahead and convert over to the common at this time because basically I can get a 2-for-1 return right now. So anyway, it's important to understand the rights that apply for the alternatives, and you can get this type of information from a stockbroker if you're looking at that. And there's also just a lot of information available on the internet now.
Yeah.
And so anyway, so that's just another investment alternative. Craig, why don't we move ahead? What is a dividend?
Whoa.
We've been talking about dividends.
Yeah,
what the heck are those things?
Dividends can only be paid out of profits. So if a corporation sells its product or services minus the costs of doing business and there's money left over, then they can pay a dividend out of that profit.
Right, so they have a choice. They can reinvest that money,
Mm-hmm.
and they should usually reinvest some of that money because you need it to grow a business and even to survive in a business. But for some companies, fortunately, they generate excess cash flow. They have more money on hand than they need, and they realistically think that they're going to need in the future. And also, they want to provide an incentive, a reason for people to invest in their stock. And so they'll, like you said, pay out a share of those earnings as dividends. Now, right now, under the U.S. tax laws, we have something that's called a qualified dividend, and what it means basically is a company, again, is paying mostly from U.S. operations, whatever, some of their accumulated earnings out, and you get a preferred tax rate. It's 15% right now. 2012 may be the last year.
Yeah.
So, and we could see that rate go up. It could go as high as 39% or so for some taxpayers in the future. We'll see what happens.
Back to ordinary income tax brackets.
But it's going to be a huge impact, and it's got to have some sort of impact on the marketplace when it actually happens.
Yeah, you spoke about corporations paying out dividends and then reinvesting some of their profits. So Apple recently converted from 100% reinvestment to paying some dividends.
Right.
And the good news about that was that stockholders now get cash. Mm-hmm. And the bad news is they have to manage that cash.
Right.
The news prior to that was that Apple was managing it and doing splendiferously.
Yeah.
And now they're distributing some of that cash to the average investor who may not do as well with it in their portfolio.
Yeah. So we'll see what happens in the future.
Yeah,
I mean, Apple has good days, had good days, and had not so good days.
yeah.
All right. Well, the next investment that we can talk about is bonds. What is a bond?
Well, a bond is a debt. While the stock is the equity, a bond is a loan from the investor to the corporation. The bond has a set interest rate. The interest is payable, is received as taxable income, ordinary income in the highest tax bracket, and is normally set at market rates. So in today's market rates, corporations are issuing bonds in the 1% to 3% range, sometimes 4%. But if you're looking at bonds in the 6% to 8% range, you're looking at very high-risk bonds. Some of the foreign countries that we've read in the news recently are issuing bonds in that 6 to 8 range. Bonds are a sometimes less expensive way for a corporation to get capital to expand a particular part of their business. Less expensive because they don't have to give away the equity profits. If the interest rate on the bond is 4% and they can grow the corporation at 5 or 10 or 15%, then they're making a profit on the equity side and only spending a part of that profit that they earn every year for the cost of the money to achieve that profit.
Right.
Yeah.
So bonds are like an IOU, just a fancy one, nice pretty paper if you've got one. Sometimes now they're electronic. Now some people have heard of something called of a debenture. What the heck is that?
Well, a debenture is a special contract for bonds, and I'm sorry, we don't do any debentures, so I'm not an expert on that field.
Okay, well, I just threw it out there as a trick question. Anyway, debentures are unsecured, and so that's something that people should be aware of. They've heard of these little buzzwords out there.
Unsecured meaning the bonds are secured with the assets of the corporation.
Some bonds may be secured, yeah.
And debentures never have any.
Yeah, it's just you're just going by the faith and credit of the company.
Okay.
And what about municipal bonds?
Municipal bonds are issued by municipalities, utilities, energy, waste treatment plants, bridges, the kind of thing that the municipality needs to survive, the infrastructure that the municipality needs to survive. And normally the municipality is given a grant by the IRS to issue tax-free dividends in either...
Interest.
Excuse me. The dividends are tax-free in either the municipality, the city, the state, or the federal, depending upon where it's issued.
Okay.
And because of that, they can issue municipal bonds with less interest rate than the corporation would charge.
Right.
So earlier I said the corporation charges 4%, but in a 40% tax bracket, the investor nets 2.5%. So the municipality could issue a bond at 2.5% and be competitive to the corporate bond, which is taxable.
Okay. So folks, Craig's calling the payments dividends. They're actually interest, but Craig deals 95% of the time with mutual funds. And so the mutual funds pay the interest out as dividends.
Thanks.
Okay.
Thanks.
Now.
That's good. Good distinction. So talk a little bit. See, I'm so stuck on the investment side of this business. So talk a little bit about municipal bonds versus corporate bonds. What's the difference in safety? Well, it all depends upon the issuer and the time and the cost of the bonds. But many investors come to me who are not in the highest ordinary income tax bracket and are buying municipal bonds anyway because they, quote, don't want to pay income taxes.
Yeah.
So earlier in my example, I said a corporate bond may be issued at 4%. After tax, the spendable amount is 2.5%.
Mm-hmm.
But for somebody who's in a very low tax bracket or less than the maximum tax bracket, their after-tax amount might be 3 or more.
Yeah.
But the municipal bond is issuing at 2.5 to be competitive with the corporate bond after tax.
Yeah.
So what happens when an investor in a lower than maximum tax bracket buys municipal bonds is that he's suffering a loss of income. He's suffering more risk in that investment that he needs to, because after tax he's getting less spendable income than if he bought a corporate bond, a taxable bond.
Yeah. Yeah. So you have to do the numbers.
Yes.
You have to figure what you're actually coming out.
It's that old thing I got started with. Investing is not just finding the best, highest rate. You need to balance it with taxes and cash flow.
What are U.S. Treasury bonds?
Well, the government wants to borrow money also. They found out that was a good deal, so they've been borrowing a lot of money. U.S. Treasury bonds are issued in an effort to collect money at the federal level or pay down self-imposed debts, which the government prints money for. We have a fiat currency. So that U.S. Treasury bond is normally a 10-year bond or more, in contrast to a note which is 3 to 5 years, or a bill which is less than 3 years. So a U.S. Treasury bill is the lowest maturity date and has the lowest risk. We call that a risk-free rate. In today's marketplace, it's down under, I'm going to guess, 0.5%.
Yeah, it's
lower.
really low. It's practically free.
Yeah. You almost have to pay the government to put your money into treasuries at this point.
Kind of ridiculous. Anyway, so we talk about deficit spending for the government, and so when the government is doing that, they're spending more money than they're taking in taxes. So they have to get the money someplace else for the most part, and so or either it's paid for through inflation or through borrowing, and so in most cases they're doing it through borrowing. And a lot of that we know is going over to China. They like our what they consider low risk U.S. Treasury bonds, and so we've mortgaged our souls to our friends overseas. Okay, moving right along, getting along beyond the political comments.
No political comments here, Mike.
Okay, so what is a mutual fund?
Oh, a mutual fund is a simple explanation is that it's a bucket where people put money into the bucket, hire a manager who uses that money to go out and buy stocks and or bonds, and the amount of money that you put in earns growth based upon the equity value of every share that's owned by that mutual fund.
Yeah.
30 plus years ago when I got started in the business, people were buying individual stocks. More than half of the brokerage accounts were individual stocks. And the response to mutual funds was, well, I can do better buying individual stocks. Truth is that statistically we've now shown that that's not true. That people who pick stocks and time the trades, whether they're brokers or brokerage companies or individuals in their kitchen table, are not doing as well as a simple buy and hold of the marketplace index fund. It turns out that mutual funds, remember when you put your money in there and you hire a manager, you have to define what his business plan is. Is his business plan to buy the whole market and hold it, or to pick stocks and time the trades? So there's two major investment methodologies. One is called active trading, where that manager studies the past in an effort to know which stock to buy and when to trade it, in an effort to beat a simple buy and hold of the marketplace. So the opposite investment methodology is a passive using index funds. So a classic index fund is the S&P 500 run by Vanguard and many other mutual fund companies. Those 500 stocks that are in the S&P 500, if If the individual manager is trading in that marketplace of those 500 stocks, his goal, 98% of the mutual fund managers are men, his goal is to beat the performance of a simple buy and hold of those 500 stocks. Turns out that over your lifetime, none of the active managers have outperformed the index, and on shorter time frames, they might greatly outperform or greatly underperform. But if you're looking for the longest term time horizon with the most guarantees to your returns, the S&P 500 is going to guarantee you the return of those stocks. All you have to do is buy and hold it. The secret is to buy and hold it.
Okay. Yeah.
Went
All
through
right,
a
folks.
big investment methodology talk there.
Yeah. We're getting close to the end here, Craig, unfortunately. Time goes awfully fast, even talking about the basics. We only have about a minute left. One thing, though, I do want to mention to people is just an important issue here that unfortunately we didn't get a chance to go into detail is the role of emotions in investing. And so emotionally, what happens is we tend to follow the herd, and unfortunately what it tends to do is it means that we'll tend to buy high and sell low, and that's not the way you make money.
That's true.
So,
statistically, that's how the market works.
And so part of the role of a fee-only financial planner is to help you in managing that emotional aspect. So I just want to get that little plug in for the financial planners there.
Thanks.
And so folks, I hope that you found this to be of value, to hear something about what are the basics related to investments, and hope that it's helped you to understand things a little better. Craig and I are going to get together another time and talk about some alternative investments. And so with that, I'll just say we'll see you next time on Financial Insider Weekly.
Thanks, Mike.